We're going to calculate the intrinsic stock price for Discovery, and I'm going to show you how to analyze this company using a discounted cash flow model. And this is how equity analysts and large investors value companies. What we're going to do is enter their financial information into the spreadsheet, and we're going to calculate their future free cash flows. And then we're going to figure out the discount rate we need to use, then apply that discount rate to the future free cash flows so we can bring those numbers back to today's value, and then we'll figure out if the stock is a buy or a sell. And then we're going to look at the financial ratios of the company. And make sure you watch the whole video, because if you hear a bell like this, that means there's going to be a message, and it'll give you more information about either the company or about the financials. And we're going to also delve into goodwill, because this company reports a negative net income one year and a positive free cash flow the same year. And we're going to show you why that is by looking at their goodwill for that year. Discovery is a media company started in 1985. It owns Discovery Channel, Animal Planet, Science Channel, and TLC, and it acquired Food Network and some other channels as well. It trades on the NASDAQ. So let's get the market cap. So the market cap is 10.37 billion. And the stock price is 21.76. So if you wanted to figure out the shares outstanding, it's the market cap divided by stock price. That gives you 477 million shares outstanding. And if you didn't have the stock price, if you want to figure that out, it's the market cap divided by shares outstanding is the stock price. So now let's get the free cash flows for the business. And that's the cash that's left over after operating the business each year. And each year they have a positive free cash flow, which is a good sign. That means they're adding value to their investors. And now let's look at net income. That's on the income statement. And they have a negative net income one year. So net income is called the profit and loss. And how can you have a $337 million loss yet generate positive cash of $1.5 billion that year? I'll show you how. And this is why you have to understand accrual accounting and the financial statements to understand the companies and the valuation. So you can see in 2017 that a $1.8 million loss. But according to Yahoo, it's just other. We don't really know what it is. So what we have to do is we have to go into the 10K to figure out what that is. And most of that is an impairment of goodwill of 1.3 billion. So they took a loss of 1.3 billion on goodwill, and that brought their net income down to a negative that year. It's a non-cash item, so it doesn't affect cash. So that's why cash went up, yet net income went down. That's why understanding accrual accounting and depreciation and amortization and non-cash items can really help you understand why these things occur. So goodwill is an intangible asset that is associated with the purchase of another company. So when you pay a premium for a company, you have to book the difference into goodwill. So let me try to show you an example. Say there's a small company and there's people looking to buy this small company, and on their balance sheet they have 10 million in assets, 6 million in liabilities. That means they have 4 million in equity, because equity plus liabilities equals assets, or assets minus liabilities equals equity. Okay, now if a big company, and this is the big company before they acquire this company, that's what this line is, they want to buy this company, the small company. So generally when one company wants to buy another, they pay a premium. They pay above the equity value. And say, just for example, they paid $5 million for this company, even though it's worth $4 million. We'll get to it later why they would pay a premium, but let's just say they paid $1 million above what it's worth. So the big company, before they acquired this small company, they had 50 million of assets, 40 million of liabilities, and 10 million in equity. After they acquired this company, they add 10 million to their asset base, they add 6 million to their liabilities, and they add 4 million to their equity. Because that's what they just take their balance sheet and put it onto theirs. So they paid the premium of 1 million above the equity, so they have to book that into goodwill. Goodwill is an asset, so they put it into their assets. So now their assets are 61 million. The 50 million they had before, the 10 million that the small company already had on their balance sheet, plus the 1 million premium. So now the new company has 61 million of assets, 46 million of liabilities, which is just the sum of these two, and 15 million of equity. So why would a company pay a premium? Generally, a company pays a premium because of a brand. Like if Nike was acquired, that they have a great brand name. Everybody knows Nike, so they deserve a premium as opposed to if you were buying another sneaker company that didn't have such a good name. And a company you're acquiring might have proprietary products like patents or trademarks. This is Discovery's balance sheet. Their assets, their current assets, which is cash, receivables of 5.2 billion. And in non-current assets, there's property, plant, and equipment, which is like buildings, machinery, things like that. But there's also intangible assets like goodwill. And in their case, they have $13 billion of goodwill. So this is probably many companies they've acquired. And that's the premium they've paid for all those companies. Every year, a company has to look at their goodwill and decide if it should be written down, what they call an impairment. Because maybe they paid, in this case, $1 million above what it's worth. And then after a few years of operating that smaller company, they realize they paid too much. So they say it actually should have been worth 500,000 more than we paid, not $1 million. We paid too much. So they have to reduce their goodwill on their balance sheet and report a loss on the income statement. The $1.3 billion loss that they passed through in 2017 resulted in them having an overall negative net income for the entire year. So, and it's a non-cash item. There's no actual cash. That's why cash flows were still positive. And this is why we forecast free cash flows, because it removes all this goodwill and amortization and depreciation stuff, which isn't real. Cash is real. And that's how you run a business, is cash in and cash out, not all these accounting things that are going on. So now the revenue it looks pretty strong year to year. It's going up every year. It almost doubled from 2016 to 2019. So that's a really good sign. So that's why if someone who's not familiar with income statements or financials says, I think the company looks good, but they took a loss in 2017, so I'm not going to invest in this company. But you need to realize that they didn't really take a loss. They just overpaid for an acquisition in the past, and they just passed through a non-cash item. So it didn't really affect their financials. They're still operating as a healthy company by generating positive free cash flow. Now let's figure out that capital structure so we know what discount rate to apply to the future cash flows. So they pay $677 million on the debt. And let's see how much debt they have. So current debt is $609 million. Long-term debt of $14.8 billion. And long-term is due after 1 year. And let's find out their effective tax rate, because interest payments on debt is tax deductible. So this is why it's challenging looking at the income statement, because there's all these non-cash things going on in accrual accounting, so it doesn't make much sense because you're not going to make $2.3 billion and then pay only 81 million in taxes. It's way too low. Or this year, you lost your income before taxes is negative 137 million, and yet you pay taxes. If you lost money, you shouldn't pay taxes. But it's not looking at that year, it's looking at prior years. So let's use the 2018 income before tax because that seems more accurate. 33% tax rate. So the cost of debt is 3%. They have a high weight of debt. 60% of the capital structure is debt. Let's look at the beta to see the volatility of the stock. It's 1.52, so it moves 1.5 times the market. So the cost of equity is 14%, cost of debt is 3%. Equity is usually more expensive and riskier than debt because equity is lower in a capital structure. In the event of a default, debt holders are paid before equity holders. So the weighted average cost of capital is 7.4%. That's a blend of cost of equity, cost of debt. And that's what we're going to use to discount the future cash flows. And we estimated the future free cash flows for 4 years. We did a terminal value, which is all years past year 4. We discounted those numbers using the weighted average cost of capital. And we have a value of the company of $9.4 billion. And when you divide that by 477 million shares, the intrinsic stock price is almost $20. And they're trading at about $22. So they're trading at a slight premium. So it looks like they were trading in the low 30s, maybe mid 30s for a little time. But they've been trading around intrinsic value, maybe in the low 20s, mid 20s for a decent amount of time. So it's been trading about at what it's worth. According to the model, it's a sell. But stock prices aren't necessarily based on what the company's worth. It's based on what people perceive it's worth. So they may look to the future of the company and say it's worth a lot more than $20, so I'm going to buy it. But if you thought it was worth a lot less than $20, you just wouldn't buy it. And really the only way to mitigate like these types of movements in the stock market is just to hold the stock long term if you feel it's a good company. If you don't feel it's a good company, you probably shouldn't buy it. Let's look at their financial ratios. Let's get some more info from the balance sheet. So let's get their current assets, 5.2 billion. Let's get their current liabilities, 3.2 billion. That looks good. Their equity. And let me know in the comments if you have any questions on why the numbers are the way they are or why people pay a premium for goodwill. Let's get the operating income. I mean, it makes sense, but like to me, but I could see someone new in investing that it just doesn't click. So let's look at the PE ratio. PE ratio is stock price over earnings per share. They have a really good PE of 5. I like to see under 15. And you got to look at to make sure they didn't buy back a lot of stock because that could drag down the PE. And there's other things. Remember how we were going through the income statement? There's a lot of things the way you report your financials that you could make your ratios look really good. Price to sales ratio, that's really good. That's under 1. I like to see under 2.2. Their price to book is 1. That's great. Current ratio, really good current ratio. I like to see between 1.2 and 2. Solid ROE, I like to see above 20. They have 21%. And that's your return. If you're investing in a company, you want a return on your investment. You don't want to see an ROE of like 2%. Why would you risk your money in a market for not much of a return? And a good interest coverage ratio, that means they could cover the interest on their debt about almost 5 times. So they have a healthy coverage there, not much risk of a default. So overall, it looks pretty good, the company, and it looks like it has a good future based on the financials, the health of the company. The only red flag is it has a little bit too much debt, but it's not too overboard. 60%. I like to say under 50%. So let's look at their ratios compared to their competitors. So the only 2 companies that I did a discounted cash flow model for on this channel are Disney and Genius. And you can see Discovery wins in most of the categories, which is a good sign if you want to invest in Discovery. They have the lowest PE. Genius has a negative PE because PE is price over earnings. They have negative earnings, so they have a negative PE. Discovery has a great price to sales ratio, great price to book. Disney has a good price to book as well. Discovery has the only good current ratio. Genius has a terrible current ratio. Disney is a little low. So let's see ROE. You don't get a read on Genius because they're not reporting any profits, so they're negative. Discovery has the best ROE by far. Disney has a pretty weak ROE.